All right, so you're here with us on the deep dive because you're that person who wants to, like, get right to the heart of something.
Mm-hmm.
You want to understand it, you want it quickly, but you don't want to miss any of the good stuff.
Right.
Maybe you got a big meeting or got to get up to speed in a new field, or, hey, maybe you just love learning new things.
Ask me.
Yeah, and you want, like, that satisfying aha moment when it all clicks, without having to wade through a ton of extra stuff.
Yeah.
So today we're doing exactly that with some excerpts you sent over from a book called Invested.
Okay.
It's by Danielle Town, and the full title is kind of a mouthful. It's Invested: How Warren Buffett and Charlie Munger Taught Me to Master My Mind, My Emotions, and My Money, with a little help from my dad.
Wow.
Yeah, right?
Okay, lots going on there.
Yeah, and what's so cool about this book, right off the bat, is that it's not just like a dry textbook about finance.
Right.
It's Danielle's personal story of how she learned to invest, and she's guided by her dad, Phil Town. Now, he's a Rule #1 investor, which we'll get into a bit more later. But essentially, that means he follows a specific set of investing principles, focused on finding those really great businesses and pulling them when the price is right.
Sounds promising.
Yeah. And what makes it even better is that she's drawing wisdom from the absolute legends of investing, Warren Buffett and Charlie Munger.
Oh, wow. So she's got some serious mentors.
Totally. So you're getting these powerful ideas, not just in theory, but through the eyes of someone who's going through it, firsthand.
I like that.
Yeah. And right away, she tackles some challenges I think a lot of us can relate to.
Okay, like what?
Well, she talks about that initial fear of the stock market. It can feel really intimidating, especially when you're first starting out.
Yeah, definitely.
And then there's the whole thing about overwork and that constant striving, that feeling of being totally drained, and that deep down desire for real financial freedom.
Oh, yeah, I feel that.
Yeah. And then, of course, she's getting this amazing introduction to the core ideas of value investing straight from the best.
So she's really diving in head first.
Totally. But one of the first big aha moments for her, and something that really resonated with me, was this realization about inflation.
Oh, yeah, that sneaky thing.
Yeah, we all know prices go up over time, but it's easy to forget about it until you really stop and think about what it means for your savings.
Right. It's easy to just kind of push it to the back of your mind.
Exactly.
Yeah.
So let's start there with what really kicked off Danielle's journey into investing.
Right. So the catalyst was actually a pretty tough one. It was the toll that her demanding career as a lawyer was taking on her health.
Oh, wow. So it wasn't just, regular work stress.
No, it was beyond that. We're talking like serious health issues, digestive problems, fevers, recurring tonsillitis, you name it.
And at first she just thought this was like normal.
Right. Her initial reaction was just to kind of brush it off as part of the job,
It's crazy how often we hear stories like that, isn't it?
Yeah, it's almost like we've normalized the state of chronic exhaustion.
Totally. Like you'll hear about a colleague who had a mini stroke or someone who burned out so badly they're having vision problems or memory loss.
It's scary.
It really is. And it's like we've accepted that this level of stress is just the price you pay for success or whatever.
And it's not just individuals, right? It's a whole societal thing, this feeling that everyone's just running on fumes.
Totally. And in the book, Danielle describes this moment with a friend where they both kind of admit that they needed change, but it's almost begrudging,
Like they know it's true, but they're not exactly thrilled about it.
Exactly. They use this term foin, which basically means, fine, I agree, but like reluctantly and begrudgingly.
I love that word. It perfectly captures that feeling.
Right. And this whole conversation leads them to this idea of financial freedom.
Okay, so how do they define that?
Well, it's actually really relatable. It's not about becoming some crazy rich billionaire or anything.
Okay, good.
Yeah, it's more about having genuine flexibility in your life,
Yeah.
And a financial cushion that gives you choices.
Right, so it's about having enough to not constantly stress about money.
Exactly. Maybe it means being able to pursue work that's meaningful, even if it doesn't pay a ton, or being able to support your family without worrying about every penny.
Or finally starting that passion project you've always dreamed of.
Exactly. It's about having the freedom to live according to your own values without constantly being held back by financial worries.
I like that a lot.
Yeah, and this is where Danielle's dad, Phil Town, comes in. He's got a ton of experience in investing, and he's really the one who starts to guide her on this journey.
So he's not just some random dad giving out stock tips.
Oh, no, not at all.
Yeah.
He's written a couple of well-known books on investing, Rule #1, and Payback Time.
Okay, I've heard of those.
Yeah, and get this. He actually predicted the 2008 financial crisis and the market bottom in 2009.
Whoa, so he's got a pretty good track record.
Right. So his advice is coming from a place of real-world success.
That's reassuring.
Totally. And it's important to note that the investing principles Danielle is learning are coming straight from Warren Buffett and Charlie Munger.
Oh, wow, so she's getting it from the source.
Yeah, her dad is basically filtering their wisdom through his own understanding and experience.
That's amazing.
It is. And I mean, we're talking about Warren Buffett, the Oracle of Omaha, with his incredible track record with Berkshire Hathaway.
Right, one of the most successful investors of all time.
Exactly. And then there's Charlie Munger, his equally brilliant partner who's famous for that wonderful businesses at a fair price
Yeah,
philosophy.
I've definitely heard that one before.
Yeah, so their ideas are the foundation of Danielle's education in investing.
So it's a pretty solid foundation.
Totally. Now, speaking of education, one of the first big things Danielle has to wrap her head around is inflation.
Oh, yeah, that silent wealth killer.
Right. We all kind of know that prices go up over time,
Yeah.
but it's easy to overlook the impact it has on your savings.
Yeah, it's not something you really think about on a daily basis.
Exactly. And Danielle has this almost visceral reaction to the realization that just holding on to cash means it's constantly losing value.
It's like that feeling of your money slowly slipping away through your fingers.
Totally.
Mm.
She even uses this vivid image of a rat nibbling away at her savings under the mattress.
Okay, that's a pretty disturbing image, but I get it.
Right? It really drives home that sense of silent erosion happening without you even realizing it.
Yeah, and it makes it clear that just saving money isn't enough.
Exactly. Especially when you consider that inflation averages around 3% a year.
Which means your investments need to at least match that just to stay even.
Exactly. So saving is important, but it's only part of the picture.
Right, so what's the next step then?
Well, for a lot of people, that first thought is, I'll just hire a financial advisor,
Makes sense. Seems like the easy solution.
Yeah. It's tempting to think, okay, I'll just hand over my money to an expert and let them handle it.
Like in that Father the Bride movie.
Exactly. Just sign me up and I'll go enjoy my life.
Right, but there's a catch, isn't there?
There is.
Yeah.
The book really digs into the whole financial industrial complex and the fees that come with it.
Oh, yeah, fees always got to watch out for those.
Exactly. So, for example, actively managed mutual funds, they often charge between 1% and 2% annually, plus marketing expenses.
And that's regardless of whether your investments are going up or down?
Exactly. You're paying them no matter what.
Doesn't seem very fair.
And then when you look at 401k plans, the fees can be even higher.
Really? How come?
Well, you've got the administrator fees, the advisor fees, and then the fund manager fees all adding up.
Wow, so it's like a fee frenzy.
Kinda. And when you consider the power of compounding over the long term, these seemingly small fees can make a huge difference.
Yeah, how so?
Well, the book gives this example of a $10 investment growing at 20% per year.
Okay.
Now, over many years, the difference between earning that full 20% and paying even a small percentage in fees can be staggering.
I bet.
We're talking potentially hundreds of millions of dollars lost to fees over a lifetime.
Wow, okay. That's a pretty powerful argument against fees.
It is, and it really makes you question the value you're getting from these actively managed funds.
Right, so what's the alternative?
Well, the book argues that individual investors, by learning to invest themselves, can often get better results.
Okay, but isn't that risky?
It can be, but the whole point of this book and the Rule #1 approach is to minimize that risk by carefully selecting companies and buying them at the right price.
So it's about being smart and informed, not just throwing darts at a board.
Exactly.
Yeah.
And the book even references Peter Lynch, who was a legendary mutual fund manager.
Okay.
And he actually said that individual investors have an advantage because they can often find great companies that Wall Street overlooks.
Interesting.
Yeah, and even Warren Buffett himself is famously fee conscious. He actually recommends that if you're not going to learn to invest actively, you should just put your money in low-cost index funds.
Oh, really?
Yeah, like ones that track the S&P 500.
Makes sense. I mean, the market historically returns around 7% on average.
Exactly. And there's another interesting point the book makes about why it focuses on investing in the American stock market.
Okay, why is that?
Well, it talks about America having certain durable competitive advantages.
Okay, like what?
Things like our geographic location.
Yeah.
We've got oceans on both sides, which provides natural protection.
Right.
And then there's our strong military, the U.S. dollar being the global reserve currency, a free press, and a culture of innovation.
So those factors make the American market more stable and attractive for long-term investment?
Exactly.
Mm.
It's not to say there aren't great companies in other parts of the world, but the book is making the case that focusing on the U.S. market is a solid strategy.
Makes sense.
Yeah. So the takeaway here is don't just blindly save your money and don't blindly hand it over to someone else.
Got it. Educate yourself and take control of your investment.
Exactly. Now for Danielle, taking control started with a commitment to a year-long investing practice with her dad.
Oh, wow. So it's like a dedicated program.
Totally. It wasn't just reading a book and calling it a day.
They were putting in the work.
Oh, yeah. They were meeting regularly, doing research, analyzing companies, the whole 9 yards.
That's cool.
Yeah. And one detail that really stuck with me was this idea of creating an investing office.
Like a physical space.
Yeah, a dedicated place where she could focus on her investing without distractions.
That's smart. I mean, it's easy to get sidetracked when you're trying to learn something new.
Totally.
Yeah.
And the book even references Marie Kondo's advice about creating ideal spaces.
Mm.
You know, that whole idea of decluttering and surrounding yourself with things that spark joy,
Yeah, I love that.
right? So Danielle created this space that was specifically designed to help her focus on her financial goals.
It's like setting yourself up for success.
Exactly.
Yeah.
And they talk about how different investors have different setups. You know, like Guy Spire, who's another successful investor, he has this really minimalist office.
Okay.
And then there's Phil Town, who's got this cozy office with a fireplace and everything.
Wow, quite a contrast.
Yeah, it's all about finding what works for you.
I like that a lot.
Yeah. And another concept Danielle talks about is voting for a mission with my money.
Okay, what's that all about?
It's this idea that you should invest in companies whose values align with your own.
So it's about putting your money where your mouth is.
Exactly. Like if you care about ethical sourcing or sustainability, you should invest in companies that prioritize those things.
Makes sense.
Yeah. And she gives examples like Whole Foods, Lululemon, and Brown-Forman.
Okay, so companies with strong ethical track records.
Right. It's about making conscious choices with your investments.
So it's not just about making money, it's about supporting businesses that are doing good in the world.
Exactly. And to make those informed choices, Danielle emphasizes the importance of defining a company's story.
Okay, so what's the story?
It's basically a clear explanation of what the business does and why it's a good investment.
So it's like your elevator pitch for the company.
Yeah, and
Yeah.
she actually stresses the importance of writing it down.
Why is that?
Well, it helps you to really clarify your thinking and make sure you have a solid understanding of the business.
So it's about being precise and intentional.
Exactly. It forces you to articulate your investment thesis in a clear and concise way.
I like that a lot.
Now, this leads us to the first of Charlie Munger's 4 key investing principles.
Okay, hit me with it.
It's all about really understanding the business you're investing in.
Sounds simple enough, but I'm sure there's more to it.
Oh, yeah. There's definitely nuance. To give some context, the book talks about the efficient market hypothesis, or EMH.
Oh, yeah, I've heard of that, but could you explain it?
Sure. So essentially, EMH says that the stock market is super efficient and rational,
Okay, meaning?
meaning that any publicly available information about a company is already reflected in its stock price.
So, like, everyone has access to the same information, and the price adjusts accordingly.
Exactly. And because of this, EMH suggests that it's basically impossible to consistently beat the market.
Okay, so you're not going to find any hidden gems out there because everything's already fairly priced.
Right, that's the theory anyway. But Buffett and Munger, their whole careers have basically been about proving EMH wrong.
How so?
Well, they've shown that the market isn't always rational.
Okay, what do you mean?
I mean, emotions play a huge role. Fear and greed especially.
Right, people don't always make logical decisions when it comes to money.
Exactly. And Buffett and Munger, they've made a fortune by being willing to buy when everyone else is panicking and sell when everyone's overly optimistic.
So they're taking advantage of those emotional swings in the market.
Precisely. Now, it's interesting that the book points out that despite this, and despite the work of Nobel Prize-winning economists like Robert Shiller and Daniel Kahneman, EMH is still widely taught.
Yeah, why is that?
Well, I think it's partly because it's a nice, neat theory that's easy to explain,
Right.
and there's definitely some truth to it. The market is pretty efficient at processing information.
But it's not the whole story.
Exactly. Real-world evidence shows that emotions and biases play a huge role.
So EMH is like a simplified model that doesn't fully capture the complexity of the market.
Right. And the book mentions some tools for gauging whether the overall market might be overvalued or undervalued, things like the Shiller PE ratio and the Buffett indicator.
What are those?
Well, the Shiller PE looks at stock prices relative to earnings over a long period of time, like 10 years. And the Buffett indicator compares the total value of the stock market to the size of the economy.
And what do these indicators tell us?
Well, they can give you a sense of whether the market is historically expensive or cheap.
So they're not perfect predictors, but they can offer some useful perspective.
Exactly. And the book even mentions how Buffett's huge cash reserves right now might be a sign that he's waiting for more attractive opportunities.
So even the Oracle of Omaha is being patient.
Totally. Now, getting back to Munger's first principle, truly understanding the business. The book acknowledges that it's almost impossible to know everything about a large public company.
Right. There's just too much information.
Exactly. And there's also this inherent information asymmetry, meaning company insiders obviously know more than outside investors.
Yeah, that makes sense.
But then the book introduces this really important concept, the circle of competence.
Okay, what's that?
It's basically the idea that while you can't understand every business, you can develop a deep understanding of some businesses.
Okay, so focus on what you know.
Exactly. And it's about recognizing your own areas of expertise, your passions, the things you really understand.
It's like that saying, jack of all trades, master of none.
Yeah, exactly.
Mm.
It's better to be really good at a few things than mediocre at a lot of things.
So how do you figure out your circle of competence?
Well, the book outlines this helpful 3 circles exercise.
Okay, I'm intrigued.
So the first circle is your passions.
Oh,
What are you truly interested in?
okay, got it.
Then the second circle is what you vote for with your money, meaning what products and services do you spend your money on?
Makes sense.
And the third circle is where you make your money, so your professional knowledge and experience.
So the sweet spot is where those 3 circles overlap.
Exactly. That's where you're most likely to find businesses that you can really understand and potentially invest in.
That's a really cool framework.
Yeah, and they give this example of buying a condo.
Okay.
You might not be an expert in global real estate trends, but you can probably understand the factors that influence the value of a condo in your own neighborhood.
Right, like location, amenities, conditions, things like that.
Exactly. It's about applying that same logic to the stock market.
Focus on the businesses you can actually wrap your head around.
Totally. Now, once you've figured out your circle of competence, the next step is finding potential investment ideas.
So where do you start?
Well, the book suggests looking to gurus.
Okay, who are the gurus?
They're basically other successful investors, people who have a proven track record of picking winning stocks.
Oh, so you're learning from the best.
Exactly.
Mm-hmm.
And one way to find out what they're investing in is to look at their SEC filings.
SEC filings.
Yeah, those are public documents that funds with over $100 million in assets have to file every quarter.
And what do those filings tell us?
Well, they list all the stocks the fund is currently holding.
So you can basically see what the pros are buying.
Exactly.
Yeah.
It's like getting a sneak peek into their portfolios.
That's pretty cool.
Yeah. And the book even mentions these academic studies that found that copying guru investments can actually beat the market.
Oh, wow. So it's not just a random strategy.
No, it's actually backed by some solid research.
That's interesting.
Yeah, but the book also warns against just blindly following anyone, even Warren Buffett.
Okay, why is that?
Because you still need to understand the businesses you're buying and whether they're priced right.
So you can't just blindly buy Berkshire Hathaway stock and hope for the best.
Exactly. You still need to do your own homework.
Makes sense.
Yeah. So once you've identified a business within your circle of competence, the next step is to assess its competitive advantages.
Okay, and how do you do that?
Well, the book uses this term, economic moat.
Economic moats.
Yeah, it's a really powerful concept. Basically, an economic moat is a durable competitive advantage that protects a company from its competitors.
So it's something that allows a company to maintain its profitability and market share over the long term.
Exactly. And the book distinguishes between a typical competitive advantage and a true moat.
How so?
Well, a typical competitive advantage might be temporary,
Yeah.
something that can be easily copied or eroded. But a moat is something more fundamental. It's intrinsic to the business, and it's difficult for competitors to overcome.
So it's like a fortress around the company's profits.
Totally. And they give some great examples.
Like what?
Well, there's brand recognition, like Coca-Cola.
Okay, everyone knows Coke.
Exactly. And it's really hard for a competitor to build that kind of brand loyalty.
True.
Then there's high switching costs, like Apple products.
Right, once you're in the Apple ecosystem, it's hard to leave.
Totally. And there are proprietary secrets like Apple's patents and their whole culture of secrecy.
Okay,
Then there's price leadership like Costco, being able to offer the lowest prices.
makes sense.
And even strategic location like Seritage owning prime real estate.
Interesting. So a moat can take many forms.
Exactly. And analyzing those examples of Coke and Apple really helps you understand the concept.
Yeah.
But the book also points out that even the strongest moats can be weakened over time.
Oh, right. Like how?
Well, consumer preferences can change. competitors can innovate,
Mm.
and companies can make strategic mistakes.
So you can't just assume a moat will last forever.
Exactly. You have to constantly monitor and reassess.
Got it.
All right, so you've identified a business you understand with a strong economic moat. Now, how do you figure out if it's a good investment?
Yeah, that's $1 million question.
Well, this is where we get into the numbers.
Uh-oh.
I know numbers can be intimidating, but the book makes it surprisingly easy.
How so?
Well, it boils down to what they call the big four numbers:
Okay, I'm listening.
sales earnings, book value, and operating cash flow.
Okay, and those tell us.
They give you a fundamental snapshot of the company's financial health.
Right.
So sales are how much revenue the company's generating.
Okay,
Earnings are the profit after expenses.
got it.
Book value is the company's assets minus its liabilities, so
Huh.
basically what it's worth on paper.
Okay.
And operating cash flow is the cash generated from the company's core operations.
So it's the actual cash coming in and out of the business.
Exactly.
Yeah.
And these numbers are all found on the company's financial statements.
That's-
The income statement, the balance sheet, and the cash flow statement.
And those are publicly available.
Yeah, you can usually find them on the company's website or on financial websites like Yahoo Finance.
Cool, so we can actually look this stuff up.
Totally. Now, the book takes it a step further and talks about the big four growth rates.
Okay, so how fast are these numbers growing?
Exactly. And they suggest looking for companies where these numbers have been growing at 10% or better per year.
Okay, so consistent and strong growth.
Right. And that could be a sign of a widening economic moat.
Interesting.
But it's important to remember that these are historical numbers.
Right, past performance doesn't guarantee future results.
Exactly. So you need to do more research to figure out if these positive trends are likely to continue.
So how do you do that?
Well, the book introduces this idea of a windage growth rate.
Windage growth rate.
Yeah, it's basically an educated guess about the company's future growth rate.
So it's not just looking at past numbers.
No, it's taking into account all the information you have about the company, its industry, its future prospects.
So it's a more nuanced and forward-looking approach.
Exactly.
Yeah.
And they give these examples of Coca-Cola and Apple.
Okay.
So for Coke, they're projecting basically zero growth because it's already such a huge, mature company.
Right.
But for Apple, they're projecting 8% growth because they see more potential for innovation and expansion.
Interesting.
So it's all about making those judgment calls based on your research.
Got it.
All right, so you've got the company's financial performance figured out.
Okay.
Now what? Now you got to look at the management team.
Okay. Why is that important?
Well, the people running the company have a huge impact on its success.
Makes sense.
And the book compares researching management to the dating process.
Okay. Well, that's
Yes, yeah. You're trying to figure out if these are people you can trust with your money.
right. You want to know if they're competent and ethical.
Exactly. And you have to do it based on limited information,
Because you can't just call up the CEO and ask them a bunch of questions.
right? You have to rely on secondary sources.
Okay, so what are some things to look for?
Well, their professional biography is a good place to start.
So their background, their experience.
Exactly. You want to see how they rose through the ranks, what their track record is,
Makes sense?
and then their management style.
Okay.
Meaning, are they more entrepreneurial or do they focus on steady operations?
Okay, so different styles for different companies.
Right. And it's also good to see if the founder's still involved.
Okay, why is that important?
Well, founders often have a deep understanding of the business and a long-term vision.
Right, they're not just in it for a quick buck.
Exactly. And then you want to look at the board of directors.
What should we look for there?
Well, their track record. Are they independent?
Mm-hmm.
Do they hold management accountable?
Okay.
And finally, you want to see how much ownership stake management has in the company.
Why does that matter?
Well, it shows they have skin in the game.
Meaning their interests are aligned with the shareholders.
Exactly. Now, another great source of information is the company's letters to shareholders.
Okay, what should we look for there?
Well, signs of transparency and intellectual honesty.
So they're not trying to hide anything or sugarcoat the bad news.
Exactly. And the book even talks about paying attention to the vocabulary they use.
Really?
Yeah. Like if they're talking about per share growth and free cash flow, those are good signs.
Okay, why is that?
Well, it suggests they have a value investing mindset.
Makes sense.
And finally, you can always check online employee reviews.
Oh, yeah, Glassdoor and all that.
Exactly.
Oh.
It can give you a sense of the company culture and how management is perceived.
So it's like getting the inside scoop.
Kinda.
Yeah.
Now, with all this research and analysis, it's easy to make mistakes.
Yeah, especially if you're new to this.
Totally. So the
Oh.
book strongly advocates for using checklists.
Checklists.
Yeah, that might seem simple, but they're incredibly powerful.
How so?
Well, they help you to avoid overlooking important steps, and they remove emotion from the decision-making process.
Right, it's easy to get caught up in the hype or the fear.
Exactly. And the book uses this great analogy from Atul Gawande's book, Complications.
I've heard of that one.
Yeah, well, it talks about how doctors use checklists to prevent errors, even in high-stakes situations.
Makes sense.
Right. And the same logic applies to investing.
So checklists are like our safety net.
Exactly. Now, even with all this knowledge and preparation, there can still be emotional barriers to actually investing.
Yeah, fear, doubt, greed, all that fun stuff.
Totally. And Danielle is really open about her own struggles with this.
Like what?
Well, she talks about feeling stressed and anxious about investing and how she tended to avoid it.
That's relatable. I think a lot of people feel that way.
Yeah, and it's that classic conflict between wanting financial freedom, but also being afraid to take the risk.
It's like wanting to jump out of a plane, but being terrified of heights.
Exactly. And she uses this funny analogy of Voldemort, from Harry Potter.
Okay.
So in the books, they're afraid to even say his name.
Right, he who must not be named.
Exactly. And Danielle says it's the same with fear. You have to name it in order to diminish its power.
Interesting. So by acknowledging your fears, you can start to overcome them.
Exactly. Now, this leads to a really powerful moment in the book where Danielle has a heart-to-heart with her dad.
Oh, about what?
Well, they talk about his departure from the family when she was a kid and how it affected her.
Wow. Some deep personal stuff.
Yeah, and it's this reminder that our past experiences can really shape our attitudes towards money.
Makes sense.
Like maybe you grew up with financial insecurity, or maybe you saw your parents fight about money.
All right, those things can definitely leave a mark.
Totally.
Yeah.
And through this conversation, Danielle starts to understand her dad better, and they develop this deeper connection through their shared investing practice.
Oh, that's sweet.
It is, and they start to speak the same business language.
Yeah.
They're reading annual reports together, they're analyzing companies, they're building this shared knowledge base.
That's awesome.
It is. And Danielle starts organizing her potential investment ideas into two categories, watching and wish list.
Okay, so watching is like companies you're interested in but not ready to buy yet.
Exactly. And wish list is for companies that you've done your research on and you're ready to pull the trigger when the price is right.
Makes sense.
And the book gives brief overviews of some of Danielle's initial wish list companies.
Like?
Well, there's Whole Foods, which she loved for their mission and values and their strong brand.
Okay.
And Costco, which she admired for their low prices, their membership model, and their resilience during recessions. And
Interesting.
then there's Seritage, which owns a bunch of real estate that used to be Sears stores.
Okay.
And she was intrigued by their potential upside and the fact that Warren Buffett had invested in them.
Wow, so she's following the gurus.
Exactly. And then there's Amazon.
Okay. Who doesn't love Amazon?
Right. But she was a bit conflicted because while she admired their CEO, Jeff Bezos, she wasn't crazy about their treatment of employees.
Right. Amazon's got a bit of a mixed reputation.
Yeah. And then there's Berkshire Hathaway.
Okay, Buffett's company.
Right. And she was drawn to their steady growth and diversification, but also concerned about what would happen after Buffett retires.
Yeah, succession planning is always a big question.
Totally. And finally, there's Chipotle,
Okay.
which she liked for their commitment to ethical food and their strong financials. But she was worried about their food safety issues.
Yeah, those E. coli outbreaks are a big deal.
Exactly. So she was really trying to be thoughtful and comprehensive in her analysis.
It sounds like she's putting in the work.
Oh, yeah, she is. And as her research progresses, she starts to organize her findings in a spreadsheet.
Okay, what kind of stuff is she tracking?
On the strength of each company's economic moat, their Big Four growth rates, her assessment of the management team.
So she's building a database of information.
Exactly. And this act of staking a claim on her research really helps her to solidify her understanding and feel more confident.
Yeah, it's like you're taking ownership of the process.
Totally. Now, even with all this knowledge and progress, Danielle realizes there can still be these deep-seated unconscious barriers to accumulating wealth.
Okay, like what?
Well, she reflects on her own grandmother, who always seemed to resist having too much money.
Interesting.
Yeah, and she wonders,